Welcome everybody to today's webcast with the topic Enabling the Future, Weekly Expiries, New MSCI Basis Trading and Volatility Strategies. Today we have a panel with Ralf Huesmann from Equity and Index Product Design, Philipp Schultze, who is responsible for sales, Thomas Winter, Head of Trading Design, and Markus Schiller, who's the lead of the project. On the next slide, you can see our housekeeping notes, which will apply for today's webcast. We are abiding by Chatham House rules for this webcast. Please do not quote the speakers or reference the webcast without written permission from both the speakers and the organizer, Eurex. We welcome questions from the audience. Please post your questions via the fact functionality on your control panel at any time. This webcast is being recorded. The recording will be made available to you soon after the live presentation. Please close all other browsers or open applications on your computer to optimize your viewing experience. And now I would like to hand over to Markus, who will start with the presentation.
Yeah, thanks, Cora, for the introduction, and also welcome everyone from my side. Thank you very much for joining the NextGen webcast. Before we dive into the actual content, I would like to give you some words on the agenda, what we like to present to you today. First, I'll give you a quick overview on the latest updates on the project and the timeline. We will then follow by Philipp and Ralf on a deep dive with the NextGen product initiatives, including some live demos in the T7 GUI. And then afterwards, we will look, presented by Thomas, into the introduction approach on the initiatives and also how the weekly options will be integrated into the main products. Last but not least, we have a Q&A session, and Cora just mentioned already, please all use the chat functionality to raise your questions, and then we're happy to discuss them. So now looking into the NextGen topic, what is it about? We're on slide number 3. You see we have two major milestones that we want to achieve. In the first step, we aim to establish a future-proof concept in order to cater for long-demanded trading strategies that we can currently not offer. At the same time, we want to achieve more flexible setup with the changes that come along with the NextGen initiative. And we also expect a shorter time to market for future product implementation. What is the actual change about? We currently have a limitation in terms of expiries. We can have maximum 1 expiration per product per month. That's driven by the current contract logic that is based on month, year. And here we intend to move to a logic that allows us to have, on the one hand, weeklies, but also daily expirations within the same product in the same month. In order to do so, we will change the logic from month-year to a day-month-year logic. You can compare it a bit with the year 2000 problem, switching from 99 to 2000, where here, instead of adding 2 years, we include the day in addition to month and year, which allows us then the higher flexibility. Concretely, we, in a first step, will introduce 3 business initiatives that are based on the new logic, as you can see here on the right, which we will go into detail in a second. But it's also important to mention that this is only the beginning, so we're not doing the whole implementation only for those 3 initiatives. That's the first step. We already have further initiatives in mind, such, for example, as the Monday and Wednesday weekly options that we plan to introduce at a later stage. The changes also do apply for the energy markets, so EEX, ECC are also adapting the technical changes and plan at a future date, which is not announced yet, to integrate their daily contracts into the main futures products on their side. With that, I would come to the next slide to give you an overview on the timeline. As going from left to right in the timeline, as you can see, we're already in the simulation period now. We have the technical changes fully up and running and have also various products or contracts available that reflect the new initiatives. The second next step is then the technical releases, where we have changes in T7, in C7 and Prisma, and also in CEF on the market data side. That will happen on June 27. And then probably most interesting from a trading perspective is what we have marked here under 2 currently planned for beginning of October. That's the what we described here as Big Bang, when all market participants are required to switch to the day, month, year logic. And at the same time, we will then launch the described business initiatives. Important to note here is the timing of when that Big Bang and the launch of the business initiatives happens is still not final. We're currently aligning with the clearing members on the exact dates. They have the major impact in terms of getting the changes ready. But we expect that we can finalize this in the next days, and will then also officially communicate the dates via circular. With that, I would hand over to Philipp, who will give you an overview on the first 2 product initiatives.
Thank you very much, Markus. So basically, this whole project is driven currently by 3 initiatives. On slide 5, we see there's 3 different initiatives. The first one is the integration of the weekly contracts into the standard contracts. This is certainly the major initiative in terms of that we basically touch here existing products. The other 2 are new additional functionalities, but with the integration of the weekly contracts, we touch existing business and existing contracts. The second initiative, volatility strategies in single stock options, and the third, basis trading in MSCI futures. So we will now go through all those 3 initiatives, including use cases, and we'll start with the integration of the weekly option on slide 6. So the current trading process looks like that we have different product IDs for the weekly options compared to the standard contract, based on the limitation that we only have 1 expiry per month. As Markus just explained, we have different product IDs for the weekly contract. So in the case of Eurostoxx, we have OESX, and for the first week, we have OES1, which is a complete different product. Now, the disadvantage of that solution is basically that we can't offer inter-product spreads, i.e. you can't roll from 1 week into the other, or from 1 week into the standard contract. This causes quite friction on the execution of strategies, especially if you want to do roll trades below the block trade size. I mean, this is something we hear since years. It also causes some issues on the risk limits for market makers. We have market maker protection on instrument level, so that means you have different market maker protections, although it's the same underlying. This is also one reason why we see a much higher number in terms of market makers for the monthly contracts compared to the weekly contract. So also there, we would expect by including the weekly contracts to also gain more liquidity on screen. And the last effect is certainly that by increasing or expanding towards Monday or Wednesday options, which are very popular in the US already, at some stage it would kind of increase the complexity to a level where it probably doesn't make sense anymore to expand. So Where do we want to go? We want to include the weekly options into the standard contract. In the example of Euro stocks, we then have OESX week 1, OESX week 2. This will allow strategy trades in between the expiries. It will also allow combined risk settings in terms of market maker protection, and it will give us flexibility there in terms of expanding towards, as described, Monday or Wednesday options. On the next slide, we see an example how this will look like. So basically, so that's the snapshot of our GUI. I will follow with a demonstration afterwards. So basically, after selecting the product, you can select the different expiries, including the weekly expiries, and it will also allow you to basically build your strategies in between the expiries. I would go shortly into the simulation environment. All right, so I hope you see my screen now. So I'm now in the T7 GUI offered by Eurex. So once you go into the order entry, let's say you want to trade a DAX option, by clicking a right mouse click, you can now select the expiry. So let's say you want to trade the 4th Friday of the March expiry. You select your strike, call or put, and now basically you can just add a leg, call calendar spread. You want to roll into the first week of April. As an example, it's an open trade. You add the account quantity. You can also add a limit here for the strategy trade, and they basically submit to the market. And if you now check the market overview, you see that the strategy has been created. So we have now the calendar spread between the 4th week and the 1st week of Friday. It has also, it can be quoted by market makers. So it's open to quote, and this will really ease kind of the execution of those calendar trades, where you can put in limit orders. So this would be kind of the weekly initiative. I would then go back to the PowerPoint presentation. And would move to the second initiative. So volatility strategies in single stock options. Whereas we as Eurex currently can offer volatility strategies in index options, where you exchange the underlying future as a cash leg, we can't offer it currently for single stock options. Normally, if you want to do a delta neutral strategy in single stock options, you want to have beside the option the underlying cash. And as it is not traded on our exchange, we have some limitation. Therefore, the current process is basically that you trade the option off book, you exchange back to back the underlying. But obviously, the limitation of that process is, first of all, that you have a manual intervention. You need to exchange the underlying cash leg. It's not a CCP trade. This also means that you need bilateral risk agreements, ISTA agreements between your counterparty. And it's also that you kind of are restricted in terms of variety of liquidity providers and also in terms of execution channels. So this basically it's just an off-book process. So going forward, what we will offer is that we, for our physically settled single stock futures that are already available at our exchange, we will offer daily expiries or same day expiries. That means For a volatility strategy in a single stock option, you attach such a physically settled single stock future to a trade, which expires in the evening and triggers a physical settlement through the CCP. So you get it, and you get the underlying with the delivery of T+2, and that means also that you basically don't have any basis risk. So you don't bear additional dividend risk or corporate action risk because it's the same day expiry. Everything is within the CCP, so it's kind of mitigation of counterparty risk. And in the end, you can access the full variety of liquidity providers, and also you choose where you want to trade, whether you want to do that trade via on-screen, Enlight, or you keep it off book. I would go into one example, and I guess, or suggest we go directly into the simulation again. So I would share again my screen. So I will use Eurex and Light as an example to build such a strategy. I use the example of a buyer option, the June expiry, 50 strike call option. And now for the type of the strategy, I can choose call minus underlying, and then the system automatically populates the physically settled single stock future, and I can choose here the T0 expiry. So the T0 is the same day expiry, which I can attach to the strategy. I can define the reference price. I can define here the delta. For an Enlight request, I could leave it also blank, that I would say, okay, I leave it to the responder to provide the delta. I can define whether I'm a buyer or seller. I want 10 times the ratio, so I want 1,000 option. This is 10 times the option multiplier, the ratio, and I want to trade 50 delta, i.e. 500 underlyings. I would send out this request. The two responders, my colleague should be logged in, so I expect now a response for that request. Here I get my response, price of 11.20. If I decide, or if I'm fine with it and want to trade, I basically just put in my account details, submit the deal, and basically you don't have to touch the trade now anymore. In 2 minutes, it will be transferred into TES, will be published to the market, and it's a CCP trade. And that's really kind of the advantage versus the current process, where you have the cash like not replicated within the CCP or Eurex risk framework. The same you can also do on screen, so it's not obviously not limited to Enlight or off book. So you also can open up the strategy via the on screen market. Same strategy. You can choose again the T0 expiry, the reference price. You also define the delta. Again, here you trade 10 times the ratio, and you can either send a limit or you leave it open. Submit the order, and now if you check the strategy screen, you see here that it's a volatility strategy that has been opened in the market, and it can be quoted by third-party market makers, and it's an on-screen trade. Good. So with that, I would hand over to Ralf, to the third initiative, I think as mentioned at the beginning, happy to take any questions later.
Good. Thank you very much, Philipp, and good afternoon from my side. I'm running here the MSCI derivatives from product development, and what you see here on the first slide is the development of that segment, and we are not showing it to make clear that that segment is growing, but rather to mention here that still the segment is predominantly block traded. So last year in total, we had 21 million MSCI futures being traded, thereof 18 million went via block. So why is that? I would say not because our market makers are not good enough, but on the next slide you can see that basically there are two different versions how you can execute MSCI futures in general or on Eurex. And what's special here on the MSCI indices is that most of them are multi-time zones, multi-countries, and multi-currency indices. And therefore, when you take an MSCI World or if you take an MSCI Emerging Market, at no point in time normally all markets are open. So therefore, when you use the order book, what you will trade there is what we would call risk prices. So here the market makers are basically quoting under the assumptions where the futures would be if all underlyings would be open at that time, which is, as I said, not the case. So most people therefore tend to do what's called basis trading. So using an index close and referencing their trade to that index close. So here, just to give you that figures for MSCI, as I said before, 85% of the trading happens via block trades, and most of that goes via basis trading, as the index close normally tends to be the point in time when the liquidity is highest on each of the cash markets. And when you compare it to Euro stocks, for example, there the test share is only like 20%, and for DAX futures just 2%. So here you can see why we decided just to do this for MSCI products. Also because most of that trading, as we can see on the next slide, happens not on the same day index, but often on the index of the day after, or even T+2. So here, we just now, by adding daily futures in front of the quarterly futures, have a mechanism with which we can simply mirror the basis trading. And the principle here, the futures price is basically the index price plus the basis. And therefore, with our instruments, the quarterly futures would be the level of a daily futures plus a spread between those two. So by adding now for each of our MSCI futures a daily future for the T+0, so for the same day, and for T+1 and T+2, we have this daily instruments as well as a spread in place, and therefore we can basically allow, in a very simplified way, basis trading by trading this spread between the two. And on the next page you have a graphical example, and you see that you would go, for example, on today short a daily future and long the standard future based on the index close of T+1. So that index close level T+1 is published by MSCI in the night between today +1 and the day after. And once this index close is there, then this daily leg expires into this index close. So then you are only left with the standard future. And for that standard future, you have paid the index close plus the basis. And why is that so important? So why are people again asking for that? So if, for example, now a client wants to trade MSCI World Futures, the broker would potentially say, oh, Australia and Japan are already closed, so therefore let's do the trade on T+1. And then what you can do with this new functionality, you trade the calendar between a daily future T+1 and the quarterly future, and then that mechanism works as described before. So the index close of T+1, once it's there, this is the final settlement price of the daily leg, and then the client has basically exactly this, a standard future for which it pays the basis plus the index close. So on the next slide then, you see, and now we are not doing a live simulation here, but this is how it looks like in the trader GUI. At the moment, you would only see there the quarterly futures. So in this example here, MSCI World Futures, we have quarterlies from March 22 to Dec 24. Then once this new functionality goes live, we would have this 3 daily futures in front, and then you can combine here the 2 via the calendar instrument, which is shown here in the red box. And basically, it works exactly the same way as a calendar roll. That means you can either execute both legs individually, but what we recommend would be to use this calendar instrument also, because this is how we want to incentivize this trade here. Maybe worth to mention that at the beginning, it might be that those calendars will not be shown up on Bloomberg, but we are working on that. It's of course a little new thing here that we are every day introducing a new T+2 contract, and the T+2 contract on the next day becomes the T+1 contract. So you have to check it via the contract date to see that you're trading the right instrument here. Good. On the next page, you see once again the current process, how you do basis trades in the environment as of today, and how it would look like in the futures, just to show the benefits of this functionality. Today you agree a trade via the basis, and then you have to wait 1 or 2 days or even 3 until the index close is there. And then you need to go back to that same trade and need to reconfirm with your counterparties, oh, this is what we now defined, and then enter the trade. In the new environment, you can all do it at that point in time when you agreed the basis. So therefore, in the new world, you have to handle this trade only once instead of twice. And therefore, you also have the right trade date recorded. Whereas in the environment as of today, you always have to wait 2 days, and then this is the trade date you get once you're entering it. Similar to that, you need to make sure that you are sticking to the regulatory compliance when it comes to trade entry time. So the 15-minute rules need to be observed when you do the block trades today, whereas later on, this is not such an issue because everything is done right at the beginning of that trade. Also important, I think, is the counterparty risk. Here you need to note that in today's environment, where you wait until the index close is there, the trade only goes into the CCP once it's entered. Before, that trade is not known, and therefore you have default risk on your counterparty. Whereas with this new functionality, the trade is immediately in the CCP, and therefore Eurex mitigates the counterparty risk. Last but not least, today with those trades, as they are per definition block trades, you need always to pay brokerage commissions, whereas in the future, if we are successful also to build up an order book here, some of those trades you can just trade then via the order book without any brokerage commission. The last slide just highlights again the different approaches for basis trading which are out there on also other exchanges. So the first two solutions are the ones we have so far. Number two is what I just described, is the current practice also on Eurex. You wait until the index close is known, and only thereafter you can add the index close to the basis and enter that into the standard future. As I mentioned, with all the pros and cons you see on the right-hand side, this is not ideal. Also not ideal in our view are those solutions shown under point 1 here, where the basis is traded as a separate product. We have that solution as well on Eurex for the Euro Stoxx 50, but first of all, it only works for products where the index close comes on the same day. And even then, you still have to do a rebooking from that first product, the basis, into the final product you want to get here. So therefore, we think and hope that our solution here, which is shown under 3, namely trading the basis within one product as a calendar trade, really helps to overcome the weaknesses which we see with other solutions. Here, I think I will stop. If there are any questions, we will come back to those in the Q&A session. But for the moment, I would like to hand over to Thomas for the last part.
Thanks, Ralf. Welcome from my side. My name is Thomas Winter. I'm heading the trading design team, which is handling all business requirements affecting the T7 trading platform. So I would like to provide a short overview what we have prepared in our simulation environment so far to support these NextGen ETD business initiative. We already have activated in the simulation environment a couple of sub-monthly expiring contracts for the in several option products. We have activated integrated weekly options in the stock option AXA, Bayer, Credit Suisse, and Nokia, and Roche. And in addition, we also activated weekly expiring options in the option on the DAX index and option on the SMI Swiss Market Index. In addition, which is not mentioned here on the slide, since yesterday, weekly expiring contracts in the Bund options are also supported. Coming to the next initiative, the option volatility strategies, as mentioned by Philipp, here we would like to introduce daily expiring physically settled single stock future contracts. And as an example, in the simulation environment right now, we have single stock futures, daily expiring single stock futures in AXA, Bayer, and Nokia, which can then be combined as underlying leg in the corresponding volatility strategies of AXA, Bayer, and Nokia. And yeah, last initiative are the MSCI futures. Here we have activated daily expiring MSCI futures with a lifetime of 3 business days in the MSCI future on the Asia market and an MSCI future on the world index market. So this is what is already available. We have also on the radar to introduce in a second activation wave, which will take place in May, the integration of weekly options in the Euro Stoxx option. This would also include the end of month options. And there will be, in addition, MSCI futures again, an MSCI future on the world index, and additional single stock futures to support daily expiring future contracts in the simulation environment. Coming to the production environment, I would like to mention that the dates which are provided here in the presentation are preliminary dates. They need to be confirmed. As mentioned by Markus at the beginning, we are still in discussions with members about the concrete dates. But having in mind that we would like to start in October, we would like to start all 3 business initiatives in October, and according to this plan, we would like to start on the 2nd Friday in October. This is basically the 14th of October, with the 2nd Friday expiration in order to trigger the integration of weekly expiring contracts in the main product. What that does mean in detail will come in a second on the next slide. But first to mention that this will be started on the 2nd Friday in October. And since we do that week by week, it will take some additional time here. It could take up to 5 weeks until the integration of weekly options is completed. The next Friday or the next weekend, we would like to start the activation of the daily expiring contracts in MSCI futures, and 1 week later, at the end of October, we would like to activate the physically settled daily expiring single stock futures, which can then be used as underlying legs in the corresponding option volatility strategies. So, as already indicated, there are a little bit more details to be mentioned for the integration of weekly options. Can we please go to the next page, which is here outlined at the example of the options on the DAX. What you see here is the usual weekly option products in the blue cells of this slide. So we have ODX1 for the first Friday options, ODX2 for the second Friday options, and so on. And that means that ODX1, as an example, in September 22 contains all first Friday expiring options expiring in September. And when these options are expiring, then the next first Friday options in October will be created. This is because we can only support 1 expiration per month, and therefore we are focusing here on the first Friday with ODX1. ODX2, the same. September 22 means they are expiring on the second Friday, and once they are expired, then the second Friday of October contracts are created. So that's the scheme which is currently in place and which is clearly a workaround, because it's definitely monthly expiring option contracts in weekly option products. So, and where would we like to go? We would like to have at the end integrated weekly expiring options, and these are outlined on the right column in the red cells. So this is a complete weekly based creation and expiration cycle. So we have second Friday options in this one cell, ODAX November 22, W2 FRA means these are the second week Friday options expiring in November 22. And the most striking feature here is that this is summarized in the main option product, in the usual option on DAX, ODAX. So the product symbol ODAX, which is different from the product symbol mentioned before, ODX2. This is now integrated. These contracts, the second Friday expiring contracts, are now integrated here in the main option product, in the option on DAX. So, and when these is expiring, then with a 5-week cycle, it would create the December 22 third Friday expiring options. Third Friday expiring options are the usual, the main principal options. They are already there. So on the next week, the November 22 monthly expiring option would create on this weekly expiration cycle 5 weeks later the 4th Friday option in December. And again, the 4th Friday option in November, when they will expire, they will create 5th Friday option in December. So this is a pure weekly expiration cycle. And this is a goal where we would like to go under the same umbrella, under the same product symbol of ODAX. And this, as mentioned by Philipp, enables you to trade standard option strategy, to roll position in a very simple way. Every option trader is familiar with the standard option strategy trading. So how we get from the blue cells to the red cells? And this is now the question. The idea is simply we would like to avoid double listing so that we have on the same point in time, as an example, second Friday options expiring on the second Friday in the main option product and in the weekly option product. That's something we would like to avoid. That is always clear. We have only one Friday expiring options. No double listing. So, and how can this be achieved? If we start on the second Friday in October, we would suppress the creation of the second Friday options in November and instead would create for the first time integrated weekly expiring options in the main product in the ODAX. 1 week later, we will do that again. In this case, it's the Monday options. So they will, in this case, these are the third Friday, the usual monthly expiring option in October. They will create 4th Friday expiring options as weekly expiring options in November. 1 week later, we have the expiration of the 4th Friday option in October. We will again suppress the creation of the 4th Friday option in November on the weekly option product and instead create the 1st Friday option in December in order to get the next sequence here in this weekly option, in this weekly options expiration cycle. And the last expiration, the 1st November Friday options, we would also suppress the creation of the 1st December option in ODX1 and instead would create the 2nd Friday December option as integrated weekly expiring options in ODAX. And now we have complete the full series of weekly expiring options, and afterward it starts the regular weekly creation and expiration cycle. So that's the way how we would like to do it for all option products which will have weekly expiring options, not only for the DAX option here, but for all others. That's basically the principle how we would like to do that. So we are now at the end of the presentation. Just to go to the last page on 21, we would like to mention that this NextGen ETD contract requirements is a requirement which spread out over the whole value chain. So if from a trading point of view, if you have done all your preparations, that's very good. But if your clearer is not compliant, then that doesn't fit. You should get in contact with your clearer in order to make sure that your clearer is also available to support sub-monthly expiring options. We know that on the clearing side, there are a lot of efforts to made in order to support daily expiring options or weekly expiring options and daily expiring futures, because the way how to identify contracts needs to be changed in the clearing area. This is something we do not need to change in the trading area because the way how contracts are identified based on a numerical instrument ID, and this concept doesn't change with the introduction of sub-monthly expiring contracts. But nevertheless, also on the trading side, please check your order routing systems, please check with your ISVs that they are also able to handle sub-monthly expiring contracts. And as mentioned, please use our simulation environment for test purpose. All asset classes supporting sub-monthly expiring contracts are now available. We would highly recommend to use this simulation environment for testing opportunities in order to make sure that your systems are up and running with these sub-monthly expiring contracts. Additional information can be found on the Eurex webpage. The link is provided here. And if you have some questions about the whole initiative, about the next generation ETD contracts initiative, then please ask your Eurex representative. We are interested to help to give you the support you need in order to make this these trading opportunities available on your site. With this, I'm at the end of the presentation, and I would like to hand over to Cora.
Thank you, Thomas. Yes, now facing our Q&A session. We already received some questions, so I will directly start with the first question from Markus. The new adjusted migration timeline means there will be no grace period and no level concept. Level 1, level 2, correct?
Yes, this is fully correct and a very valid question. We have not fully officially communicated this yet due to the ongoing conversations that we had in the last weeks, but indeed that's our plan. We will not offer a grace period anymore. That's due to the feedback we have received from many participants based on the fact that if members are on different levels, one member is already on the day, month, year logic, the other one is still on the month, year logic, that can cause issues in the give up, take up. And in position transfers. In order to avoid that, we have decided that we will remove the grace period, and we have a concept now in place where each and every participant is supposed to migrate to the day, month, year logic at the same date, and hence the level concept, as we've communicated so far, is no longer required in that sense.
Okay, thank you, Markus. Then coming to the next question, which is for Thomas. Do I understand it correctly that the product name OEB4 becomes OESBW4, per example, ODX1, then also ODXW1?
Yes, basically that's correct, but a little bit careful. You have to distinguish between product symbol and the time of the expiration. So the product symbol indeed will change from ODX1 to ODAX, as explained in the slide before. So there will be, we call it weekly expiring options product, ODX1, and all contracts will be put together, will be summarized by ODAX, by the main product having the same underlying ESIN. So, and in order to distinguish these first Friday expiring options with the third Friday expiring options, with the main option contracts, so we have this extension December 22 for December expiration minus W1 means first week in December 22, and FRI is indicating that it is a Friday. We just mentioned before that we already have on the radar to also include Monday and Wednesday expiring options. So in this case, Friday would be replaced by Monday and Wednesday, just to mention that. But basically, yes, the answer is yes, we will get rid of these ODX1 symbol and just retain the main option product symbol ODAX. And this applies for all other weekly option products, which are summarized to the corresponding main option product.
Okay, great. Thank you, Thomas. Then the next question for Philipp. If traded on simulation, the daily expiring futures, will it be visible in the reports, the expiry, future-based instruments? Will there be any additional reports?
Thanks for the question. So basically, there are not additional reports, but additional fields. Because we have this contract date, which refers to the expiry date, we have this additional field where it's basically visible which expiry was traded. Maybe I would shortly share again the simulation. Going back to the example I had before, when we traded the volatility strategy in Bayer, including the physically settled single stock future on Bayer, you see then in TES time and sales that you have here one trade is the call option, and here the second leg is this Bayer physically settled Bayer single stock future with T0 expiry. You also see here that you have the contract date and also the expiry date here as a field. Maybe just to explain the difference, the contract date reflects the known expiry date of today. The expiry date is in some cases different to the contract date. One example are MSCI future, where you have the contract date referring to the Friday and the expiry date referring to the Monday, where we basically settle then the contract based on the official MSCI closing price, which we only get on the weekend. So those fields are visible, be it in simulation or on the reports.
Okay. Thank you, Philipp. Then we have another question. If we are thinking about rolling out daily options in ODAX similar to the weeklies, I think this is for a general question. So Markus, would you like to take this question?
Yeah, I can start, and then Philipp, Thomas, feel free to jump in. In general, we don't have that currently in mind that we will do that in the near future, but of course we're looking for different options how we can diversify and extend our product portfolios. Might be something that we look into further down the road, but currently that's not on our radar.
Okay.
I mean, just to comment here, I mean, we have on the radar to introduce additional weekly expiring option series, Monday and Wednesday expiring options already mentioned before. So that comes pretty close to daily expiring options, yes, but there are no plans to integrate or to have daily expiring options so far. We are looking more from a weekly options creation and expiration cycles to that point.
Okay, thank you, Markus and Thomas. The next question is on the Big Bang. Big Bang means all weekly options will be migrated to the main product, or migration will be done week by week. Markus and Thomas, would you like to tackle that question?
Yeah, I can take this question. I mean, as mentioned in the slide before, the all MSCI futures supporting daily expiring future contracts, they will be activated at one point in time. All physically settled single stock futures supporting daily expiring single stock future, they will be activated at one point in time. We would not like to do so for the integrated weekly options, because this would mean that we would create double listings. And this is something we would like to avoid. And therefore we do the integration week by week as outlined before, in order to avoid any double listings here.
Okay, thank you. Then probably another question for you, Thomas, is in the circular number 29/2020, it was mentioned that the day of the week, e.g. Friday, or the end of the month will be part of the display name for the T7 trading GUI. for the weekly contracts. When will this be in the simulation environment?
Thanks for that question. That's an interesting question. Yeah, we only support end of month contracts for the Eurostoxx options and Eurostoxx ESG options. And this will be done in the simulation environment in May, where we have concrete plans to provide or to do the transition from weekly option products toward integrated weekly expiring option contracts in a production-like way. And this would also include end-of-month contracts, which were completely integrated into the Eurostoxx option product, into the main option product. And this will come in May in the simulation environment.
Okay, perfect. Then we have one last question, which is, could you please tell me if there is a way to associate the weekly options decommissioned to the main options to which they will be merged? Here's also an example, OSMX to OSEX and further. Thomas?
That's pretty much going the same direction as the question before. Yes, the end of month option contracts will also be included in this integration procedure together with the weekly expiring options. And yeah, as mentioned before, this will be done when we are supporting integrated weekly and end of month expiring options in the Eurostoxx in the course of May, of the month May.
Okay.
Maybe to add here, as we've heard that question coming up before in client talks, where there was a demand for clear mapping, so which weekly options product is going into which standard product. We have an overview of all the weekly options products that will be decommissioned on the website. There you can find a file with them all listed, and we're currently looking into extending that by a mapping so that you can see clearly what is the standard options product where the weekly or the current standalone weekly product will be migrated into. Okay.
Many thanks. Then I think the webcast comes to an end. Just for all of you, this webcast was recorded and will be made available on our website soon. So if one of you missed the beginning or the end, you can watch it afterwards. Yeah, thank you very much and have a great afternoon.